When I was at PayPal, we were founded in 1998. We went public in 2002. So it was only 4 years between when the company started and when it got public. And Amazon was public within 4 years, and eBay was public within 4 years, and Yahoo went public in 4 years. Your investors had liquidity.
Yeah.
Now you get companies like Airbnb taking 17 years to go public, and Palantir, I think, was 17 years. SpaceX is 20 years old and still private. And the result is a lot of those early employees are in, or funds that are in year 3, 4, 5 of a company. They're now waiting 12, 13, 15 years to get their money back.
Today we had Aman Verjee on the pod. Aman is the founder and general partner at Practical Venture Capital. Practical Venture Capital is a VC secondary firm providing liquidity to LPs and GPs. Prior to founding Practical VC, Aman has been a business executive with 15 plus years of experience in high growth and technology companies. He has worked at companies like PayPal, eBay, Sonos, to name a few. Most recently, he was the COO at 500 Startups. This is where he met his co-founder Dave McClure. During our conversation, we covered a bunch of topics, starting from how did he get into venture capital, the founding story of Practical VC, what is Practical VC, thesis behind investing in fund secondaries, the current state of secondaries, what does the future of liquidity in the market looks like, how is Practical VC different, and what is it looking to become in the long term, and much more. Now I bring you Aman. Awesome, Aman. So good to have you on the pod.
Great to be here. Thank you.
Perfect. So Aman, maybe a good starting point can be what drove you into the world of venture capital, and what was the founding story of Practical VC?
Yeah, we've been a firm operating here in Silicon Valley for about 4 years now. My background was really studying economics and Stanford University, and while I was there, I met Peter Thiel this is back in the mid 1990s. So this is before he was really Peter Thiel. I mean, he was Peter Thiel, but it was before he had made any of his big investments, and he was working at a hedge fund called Clarion Capital. And then he founded PayPal in 1998, and that was a venture-backed company. And when I joined a little bit later, it was a successful but still a venture-backed startup. So I got my first entree into meeting the venture community and the investors through Peter and PayPal. Then the company went public in 2002, and I was part of that IPO team. In fact, my first job with Peter was sort of the junior guy in the IPO deal team. So I got to meet all the investors and all the venture backers and the bankers. Prior to that, I was studying economics at Stanford and had worked on Wall Street for a little bit. So that's really what I thought I was going to do when I was a kid, is just to be an investment banker and to be part of that banking community. And Peter kind of pulled me into the venture tech world through PayPal, and I stayed at PayPal for 10 years after that with operating finance roles. And so that was really how I got into the venture community. I've been an operator for about 15 years in different CFO and finance roles. And then in 2017, another early PayPal guy, a friend of mine named Dave McClure, he started 500 Startups, and I went to work for him. So I kind of moved from the operating side to the venture side as an investor. Spent 3 years at 500 Startups as their COO and managing partner. And then Dave and I started this new fund about 4 years ago.
Got it. Man, tell us a bit more about what is Practical VC, and what was the founding story? What's the thought process around it?
Yeah, our experience in venture capital had been making a lot of these early seed and Series A stage bets through the 500 Startups network. That firm now has a couple billion in AUM, has made probably 2,500 investments across the board. And Dave's first fund was a 2010 vintage. So somewhere around 2017, 18, 19, when I was working at 500 Startups, I was watching how the fund was performing, and it was doing well. But there were a lot of limited partners who wanted to sell. For whatever, out of hundreds of LPs, it'd only be like a dozen who needed liquidity. But every quarter we'd have a meeting, and the meeting would always be like, fund's doing well, these companies are doing well. The first question was always, when are we going to get liquidity? When is this company going to go public? When am I going to get a distribution? And my answer was always, I don't know. We can't make companies go public. The biggest companies in our portfolio they're IPOable. They're ready to go public in the next couple of years, but you can't predict when a particular company goes public and what the founder wants to do, or what the CEO wants to do, or if the IPO window is going to be open or closed. So we always had to address this question, like, how do we get people early liquidity if that's what they want? So it was really Dave who had the idea. Hey, why don't we do a secondary firm? Well, we'll come in and we'll buy these limited partners. Fund's doing well, companies are doing well, but the LP needs money. It's not a broad-based, I'm buying out everybody. It's I want to pick and choose the LPs who really need to sell, and we'll get 30-40% discounts to fair value by just taking them out. It's good for them because they want money now, not money later. It's good for us because we're getting in on a fund that's doing well, but at a 30% discount to what we think it's worth. It's complicated. You have to be able to understand a portfolio and how it works. If you haven't managed a fund before, that's challenging. But if you have managed a fund, you realize there's a natural progression of companies that are supposed to go from the C to Series A to B to see. Valuation policy matters. If you don't know how to, check the valuation policy of the GP, you can get caught because you don't really know what the assets are worth. There's a lot of asymmetry of information in the private tech sector because companies don't have to share financials. So you kind of have to know how to triangulate and really value a company. And you have to have enough of a network and experience, I guess, to channel check how the companies are really doing as opposed to maybe how people think they're doing. But if you have those skill sets, and Dave and I have been around the block enough that we have those skill sets, we think there's a great opportunity there. So we launched the first fund. That was the genesis behind it. It's just identifying these good performing funds, take out LPs who need money. We think it's a 20-30% discount under normal circumstances. Closed our first fund in 2020, March of 2020, just as the pandemic was rolling over the world and everything was shutting down, right? So the markets were down significantly, and we got 40% discounts in that first fund. And then the companies did great, and we picked and chose. We decided, let's go after SaaS and e-commerce companies that we think will benefit from the downturn. Fintech, let's not do, a lot of crazy stuff. Let's just stick to what we think are good businesses that'll get acceleration from the pandemic. That turned out great. So our first fund is up 3x. We've done distributions along the way. We closed our second fund about a year and a half ago. We're still deploying out of the second fund. And so far, so good. We're getting 30, 40, 50% discounts to fair value right now in this market. So we think it'll be a big opportunity for the next decade or so, at least.
Got it. And Aman, so when you're evaluating GPs or LPs, what's the process like? What are the things that you look at, and what's the portfolio construction of Practical VC?
We are putting probably 2/3 of our capital into funds, into LP interests. So we're buying out LPs that want to sell. Sometimes we'll talk to general partners who want to sell. In those cases, you're getting essentially a slice of the portfolio that they've already built. So we don't have to pay that much attention to who the GP is or evaluate the GP because they've already done their deployment and their work by the time we come in. We're looking at funds that are 5 or 10 years old. So they're fully deployed, fully called. It's really just what are the assets and how are they doing? The GP's job at that point is just to, they're not even managing the portfolio. They're taking their distributions and their receipts. They're putting it back to us, the new limited partner. So it's just making sure that they are providing a level of governance and the valuations are correct. And, we're assessing their homework in effect. So that's the process of evaluating the funds that we want to buy. What we do have to look at is what does the fund own? What are the assets? So are they companies that are in a category we understand and like? Are the companies growing? Do they have good unit economics? Do we think that they're on a track for an exit? And usually in a fund, so we'll get the whole SOI from the fund manager. We'll go through the assets one by one and do our diligence. A little bit of our capital now is in companies. So there are a lot of companies that are, in this environment, they're not getting liquid. Employees need money. People leave the company, have exercised options. They have shares. They want to sell. Founders need liquidity. In those cases, we're looking through, we're assessing the company and how the company is doing based on their financials, based on their cap table, we've got a checklist of things that we like about companies, usually around growth, profitability, something about the team and the technology. Do we think they've got a market that they can go after? Are they positioned in a healthy way versus their competition? And that's basically the checklist we go down.
Got it. So it seems like you're mostly, investing into GPs or funds and LPs. So Aman, why not doing direct secondaries into companies, and why investing in venture funds?
We'll do a little bit into companies. I think in 2020, when we started the process, what we were finding was there's a very heated competitive market now for company secondary. As that market has developed, there are a lot of well-known brand name unicorns that are on marketplaces or going through brokers. So when you're trying to go after Stripe or SpaceX or Databricks or Instacart up until last week, you're competing with a lot of retail investors, family offices, people who want to buy into those companies. The fund interests are very illiquid. There's no marketplace. It's no one like Forge or EquityZen who's doing this for marketplace, creating a marketplace for funds. So it's a very inefficient market. So what we believed is when we find these limited partner interests that are very liquid, that's usually not a brokered process. We're not competing. We're not in an auction. We're not trying to buy something in competition with other funds. It's really just a one-on-one negotiation. And so it's a much more inefficient market, which is good for us. Maybe not as good for the seller. Whereas the company, especially for a well-known brand name unicorn, it's a much more efficient market.
Got it. And so Aman, maybe correct me if I'm wrong. You guys are the only one doing what you're doing right now, and why no one has, or very few people have done what you're doing? Is the timing right? What's going on?
I wouldn't say we're the only ones. There are a few firms who will do it. Industry Ventures here in the US is one example. In private equity, this has been going on for a long time. So there are big PE shops that do secondary trades. There are folks like Collar Capital, KKR, and Apollo, and some others are publicly traded. So they're actually selling their interests to the public markets. So there is a pretty efficient and large PE secondary market out there already. It hasn't really happened for venture yet. And I think the reason was because until recently, there wasn't really a need need for it. Like in 2008, 2009, when there was a big downturn, there was a lack of liquidity, and that's when the PE market really got rolling. But even at that time, like when I was at PayPal, we were founded in 1998. We went public in 2002. So it was only 4 years between when the company started and when it got public. And Amazon was public within 4 years, and eBay was public within 4 years, and Yahoo went public in 4 years. So that whole Gen 1 of internet companies didn't take a long time to get public. So your employees, your investors had liquidity, right? You got shares in a public company. Now you can hold those shares if you want to, but at least every quarter, every year, I had the option to sell my PayPal shares. I was never really locked up.
Yeah.
Now you get companies like Airbnb taking 17 years to go public, and Palantir, I think, was 17 years. SpaceX is 20 years old and still private. So it's a very, very long time for companies now from the founding to when they get liquid. And the result is a lot of those early employees are in, or funds that are in year 3, 4, 5 of a company. They're now waiting 12, 13, 15 years to get their money back. And that's not great for the asset class, and that's not great for them, because it's very hard to plan 12 years ahead if you don't have an infinite timeline. So now we're seeing a lot more need for liquidity in the venture space, just as it happened in the private equity space. And I think the last couple of years have been really good for venture secondary. I think over the next 5 years, there'll be a lot of other, venture secondary opportunities. So I think we're early in the early innings of it, and we're certainly one of the leaders in the space right now. But I'm sure it'll get more competitive and more heated as this market evolves.
Yeah, no, absolutely. As you said, the Gen 1 companies who are going public in 4 to 5 years, and now it's taking 15 years to go public. And of course, LPs are looking for liquidity and capital. There has to be another player in the ecosystem, sort of like, helping continuing the ecosystem overall. And Aman, when you were raising your first fund, and of course, you've raised second and third types of LPs you were going after, and why are they investing in you? Like, is it a different investment return that they're looking at, or what's the thought process like?
Yeah, we'll go after anyone with money. Doesn't really matter. We'll have the conversation. Where I think it resonates the most is with family offices and entrepreneurs, people who want to invest in venture and in technology. Part of the challenge with, I think, investing in that category, if you're not a practitioner, you haven't been doing it all your life, is you have to be able to select the managers that you want to be able to work with. Getting into companies is always challenging if you're not a professional investor. So people like funds, not companies. If your inkling is, I want to be in Silicon Valley, where you have some experienced managers like Aman and Dave who've been doing this for 15 years. I think in Dave's case, it's 15 years. In my case, it's more like 6. But Dave is a 2-time member of the Forbes Midas list. So he's somebody who has a lot of credibility with LPs, and you can invest on his track record. And so I think investing with a fund manager, it's always one checkbox. Your track record matters. And then for a secondary firm, the plan is we're getting in around year 5 or year 7 of a fund. So you can expect your money back in another 5 or 7 years. You don't have to wait 15 to get your returns. So it's a shorter time to liquidity. That's probably good for IRRs. Yeah. And we can get a discount to fair value like you can in this market. It may not be true in all markets, but if you can get a 30, 40, 50% discount, the prices that were paid by Sequoia or Dragoneer or Founders Fund in their latest primary rounds, then you've got some alpha. And so you're as an investor, the LPs that seem to want in are, hey, I like the shorter time to liquidity. I like you can get into it at a discount. We've got some seasoned managers who can manage these investments. If you're in Silicon Valley and you're here, there's a lot of deal flow and opportunities, but not everyone lives in Silicon Valley. So people in New York, Florida, or Dubai will want to make investments because it gives them an entree to a Silicon Valley fund with Silicon Valley type returns. People are on the ground, and they don't have to make those investments or try to curate those investments on their own.
Got it. So it seems like shorter time for return on investment, and of course discounted price. And then typically, what the LPs are looking at 3x, 5x the fund. What's the math behind it?
Yeah, I think in a typical the way that we're underwriting it, we're thinking it's only a 7-year fund, so we don't have a 10 to 15-year horizon. If we can get to a 3x in 3 to 5 years, 20. I think of it more in terms of the net IRRs. We're aiming for north of 20% net IRRs.
Got it.
And so that's really what we're shooting for. As an example, if you take an early seed stage fund, but let's say it takes 15 years to get your money back, you can do 10x as a seed stage fund, but 10x over 15 years, that's still mid-teens net IRRs. So we think we will do better than your typical fund on the net IRR, but maybe not as big a multiple. We're not going to be a 10x fund, but we're not going to be a 1x fund either. The goal is to get a net IRR north of 20%.
Got it. And Aman, typically, what kind of check sizes Practical VC writes into funds or LPs, and how many deals over the entire fund you're looking to do?
We'll probably do 1 to 5 $5 million check sizes, maybe a little bit smaller if it's a company, could go a little bit higher if it's a fund portfolio. And if we have a $100 million fund, that's our target for PVC3. So that might be about, let's say 20 to 30 deals across different portfolios. And that would be how we would deploy the fund.
Got it. And what's the magical outcome you hold for Practical VC in the next 5, 10, 15 years?
I think the first stage is, I think just, because we're new in the secondary space, I think we're still figuring out some of the tools and tricks and how to make this market work. So I think getting fund 3 to fund 4 to fund 5, that's continuing to build the AUM and the practice. I think ideally building out a practical toolkit, that actually tells founders and fund managers, here's how we would value the portfolio. So if you want to buy or sell your portfolio, right now it's very much a discovery process. It's not like going onto a stock exchange and buying something with standard terms and disclosures and a quick settlement. This is all very complicated. A lot of bespoke legal agreements. It's highly negotiated. I think ideally what we'd like to say is here's 3 things we can do for founders. If your company meets these metrics, and we can be very clear about what those metrics are, we'd like to buy, but here's how we would price it. Here's how we would value it. Here's the information you got to give us, and we'll give you back an offer. But making this a more repeating, an easy process for founders and LPs to understand, creating some kind of a liquidity marketplace would be ideal. I think that's where we want to go. And then ideally in terms of how we want to treat our LPs as well, because they're also locked up in illiquid, finding an avenue for a public listing where we can be a publicly traded fund and have investors come in and come out at a price, whatever the price the market clears would be great. So I think phase 1 is let's raise the next couple of funds to get the track record and just refine the tools that we have, make those tools more efficient for sellers, and then give buyers liquidity by having a public listed exchange.
Got it. And Aman, you're only investing in US, or it's you are looking at deals globally?
We're looking globally. We'll probably do 2/3 in the US, 1/3 outside of the US. If I had to map the venture community, it probably looks like 70%, US. I think globally it's probably half in the Valley, another 20% in the US, but outside of the Valley in places like New York and Boston, a little bit of Seattle or Austin or maybe Florida, but heavily concentrated in Silicon Valley and maybe LA. And then I think the other third of it is global right now, but that's growing, right? Every year, I think the global, we've seen probably more unicorns coming out of, let's set aside China for a second, but out of Southeast Asia, out of MENA, out of Latin America, we're seeing more and more companies and unicorns and successful founders every year. And I think every year Silicon Valley loses a bit of share and every year everyone else increases. So I think over the next 5-10 years, we'll kind of follow where the market is going. And we want to be, except for China, I think we want to be global and thinking about pretty much every region, looking just for the best values and the best deals.
Mm-hmm. Yeah, I mean, the the problem that you're solving exists across the world, not just in US and even in India right now. There are no secondary funds. It's still in the nascent stages, and of course, later on down the road, there would be opportunities for you guys to be doing something in India as well. And Aman, you've been building Practical VC for the last around 3 years. What's something that you know now you wish you knew earlier?
Well, there's a lot. I kind of wish I would have known how the market would have evolved. I think I had an inkling for how the market went in 2020, 21. I think knowing what you know now, I think this market cycle is going to be pretty prolonged. So I think there's going to be a period now when people need money over the next 12, 18 months. And the public markets will slowly reopen, but it'll be start, stop. I think we'll see some good signals in Q4, but it doesn't reopen right at once. Mm-hmm. So I think just being disciplined about our investments. I think we have done a good job of being disciplined in our investments, but I think we also, have the ability to deploy in a very favorable market cycle. And I think just learning how to manage your money in versus money out is something every fund, especially during the cycles, has to kind of work through. I don't know that there's anything, I think luckily we've made the right decisions for the most part. We were aggressive in fundraising in 2020 and 21. We were very careful about deploying in 2022 at those higher valuations. And that was a little bit of good fortune. But I think if I had to advise other fund managers in what they're thinking about, if you were deploying in 2020, 21, just because of the vintage and the valuations, those funds will not do well. I think 2023, 24, they will do well because the valuations have corrected. Okay. And inevitably venture follows kind of a weird counter cycle where when things are expensive, like they were in 2021, everybody wants to get in the game. Everybody wants to deploy. Everyone wants to, buy the most expensive Gucci shoes at full price and then some, because the prices are being bid up by, SoftBank and Tiger, and then all this retail investors jumping in. It just made it a very frothy market. And now everyone's scared, right? Everyone is thinking, oh, where's the bottom? valuations are low, companies not growing, there's going to be worse to come. I don't want to deploy.
Yeah.
But that's exactly the opposite instinct. The instinct should be when those Gucci shoes go on sale, same shoes, the exact same shoes, when they go on sale for 40-50%, that should be when you want to buy. But now everyone's scared. I think the old maxim from Warren Buffett is, when others are greedy, be fearful. When others are fearful, be greedy.
Yeah.
Easier said. It sounds great. It sounds right. Easier said than done. So I think just having the will right now to be aggressive and getting your evaluations and jumping in now is really good advice. But it's hard to I think it's hard to pull off.
Yeah. Seems like you have actually followed Buffett's advice, and it's really hard. Everyone knows that's a good advice, but almost no one does it. And Aman,
we were very thoughtful at the top of 2021. We had a very good debate internally. Actually, what another great piece of advice is find a co-partner or founder like Dave McClure that you disagree with, but have a civil conversation about these different ideas. But have somebody who is of a different point of view and complementary. And I think the way we went back and forth was, should we deploy capital in 2022, knowing that the valuations are still expensive? We're money managers. We're paid to put money to work. We're getting paid a management fee based on what we deploy and what we raise. So shouldn't we keep deploying capital? And if we're a top quartile fund and outperforming everyone else, isn't that good enough? And then the other view is, these valuations are still too high. So let's just take almost a whole year off. Don't deploy until the valuations come back to where we think they are, even if that means like not doing a capital call for the whole year. We didn't do a capital call in all of 2022. So we held our fire all the way up until really last quarter. And now I think we're lucky that we did, because the valuations are now 40% lower than they were in 2022. So I think just having that, that ability to kind of look at that broad cycle, and maybe some of the experience, having been in it for 15 years and knowing and understanding market cycles, gave us an advantage. Like, now is the time to deploy, not 2022. So I think we came out on the good end of that.
Got it. And it's 40% lower than last year. Plus, you guys are getting even more discount on top of that.
Yeah.
It's time to go aggressive. And Aman, with this, we'll transition into so my co-pilot in the back. His name is Alfonso, and he wants to get in. So he's the one who actually drives the final portion or final part of the pod. So he's asking, what's your typical day like, Aman?
What's my day like? So in the West Coast, so I travel 100 days of the year. So all those days are different. But for the other 250, the early morning routine is typically, I try to get up at 6 in the morning. So between 6 and 7, you got some productive time. And then, you're the kids and all the making the breakfast. And I do push-ups and planks with the kids in the morning. So I take physical fitness very seriously. I make my kids do push-ups and planks, and they do a whole morning routine, and then they're off to school. And then I'll find that early morning in the US is a good time to do phone calls and work from like 8 to noon. And it's, half fundraising, half deal sourcing. I'm also, we're working through the fund management overall. So there's like quarterly newsletters and stuff like that has to go to our LPs. We'll try to do a quarterly LP meeting. We'll do quarterly newsletters. We'll do quarterly posts and blogs that are on our website. So a lot of that is just content creation and following up on work. And then that's, then you get the afternoon in the East Coast and evening in Europe. Mm-hmm. So then it's harder to do phone calls. And we've got a lot of LPs in that corridor. My partner right now is in Singapore. So we cover all 24, between us, we cover all 24 time zones. So that's good. But that's trying to be productive and, try to work in the morning. And then in the afternoons, it'll usually be, I try to take 2 hours every day. It's usually between noon and 2 or somewhere around that for myself. And that self-time is basically going to the gym and working out. So it'll be go to the gym and we'll do some kind of workout, cardio, lifting, kind of rotate through different things. I'm now competing in some obstacle course races like Spartan and Tough Mudder in a pretty competitive way. So I have to train properly for that stuff. And then it's like meeting companies in the afternoons here in the Bay Area when everyone else is kind of going to sleep on the East Coast or in Europe. And then it's like, then I'm like picking up the kids and being a dad in the afternoons for soccer practice and bringing the kids back and getting them settled through homework and everything. My daughters are 12 and 9, so they're a great age to be like, they're pro dad. They're little girls. They're little daddy's little girls. Sometimes fight with the mom, not always, but sometimes there's that tension, which I'm the beneficiary of, and that's fine. But I know the 12-year-old's getting away from me soon. She's already going to earrings and side hugs and, drop me off here at the bus stop and I'll walk the rest of the way. So I have limited, innings left with her, limited time left with her for sure. So I'm trying to enjoy everything that I can.
Got it. And Aman, we were talking about this. You are a Jack guy, and what's your relationship with health?
I try. No, I try. The health is something I didn't take that seriously when I was younger. It came easier. So I was always, athletic and running around and active. Even in high school, I'd be running around and active. And I played pretty competitive ice hockey growing growing up in Canada. And then you get into, college and some of it goes and you don't have a discipline around it. And then you get into work, and I worked on Wall Street, and it was like 8 hours a week. And back in those days, it was like eating whatever you want to, lattes in the morning, pizza, and at noon, and then whatever at dinner, paid for by the company, snacks all day. And I put on a lot of weight. And I think at my peak, I was probably 250 pounds. And then bit by bit, then I was at PayPal for many years, and I kind of found some balance, but it's still not a very balanced life. But I'd go to the gym, and I'd still work out, and I still enjoy some of that. And then maybe 5 years ago, I'm like, I got into my 40s, and I was realizing the body doesn't, maintain. Now I'm putting on weight that I didn't put on before. It feels like things hurt that aren't supposed to hurt. It takes longer to recover. And I was just terrible at nutrition. And I think bit by bit, I came to the realization I have to find a better, healthier balance. And so then I began thinking more about nutrition and what I eat, which is like 80% of it turns out, and being a bit more disciplined with my physical routine and mixing in cardio and some just things like Pilates, things that are helpful as you get older to kind of work different muscle groups and be a bit more disciplined about it. And I really enjoyed it. So I kept doing that. I actually hired a nutritionist here in the Bay Area where we go through macros and we go through what are you eating? How do you find the right balance and find something that's more sustainable? I brought the weight down from 220 or so down to about 175. I've put on about 10 pounds of muscle, so I'm back to 185, and I'm competing in these obstacle courses, Spartan races, which is like a 10K, 21K, running over obstacles, underwater, over things, carrying 100-pound sandbags up and down a hill. And I just like the competition and enjoy that stuff. So, I've made that part of my routine where every day I go for 2 hours and I have goals, and I have sometimes trainers, sometimes not. I have a routine that I rotate around through, and I just try to make that, part of what I do. So when I get older, when I hit 50, 60, 70, I just want to be, living a good life. I don't want to be, I don't want to live forever, but the time I do want to live, I want to make sure that I can still run around and follow my kids and still be, athletic and productive and have fun in what I do.
Got it. Love it. And Aman, we were talking about this earlier. You are reading book, and of course we talked about reading Outlive by Peter Attia, and you yourself are working on writing a book. I would love for you to maybe, tell us what the book is about and what's the thought process behind writing the book.
Yeah, I enjoy writing. And I think at this stage in my life, I want to do things that I enjoy doing. So for many, many years, I just didn't spend a lot of time writing. But when I was in college, I was editor of the school newspaper. It's actually how I met Peter Thiel. So I've always enjoyed the process. And I did actually write and publish a book back in 2004 on George Bush and the political election at that time. And I still enjoy, in fact, the book that I'm reading right now is about the 1896 election in the US. So I just find this stuff fascinating. History, financial history. And back then I began thinking about a book on financial bubbles. Because I read some great books about the rise and fall of Lehman Brothers, the rise and fall of long-term capital management in 1998, a little bit about the Great Depression. I'd studied some of these at Stanford, but I like reading about that stuff. And it struck me that there's no one book that covers all the major financial bubbles in history not at a hugely detailed level where you go through, asset prices and stochastic methodologies to determine standard deviations from norm. It wasn't all that. It was more like, just give me an accessible book that I can understand as an econ student that talks about the socioeconomic, maybe political backgrounds to different bubbles. Amsterdam in 1637, South Sea bubble in 1720, the Great Depression, the 2008 bubble. And in 2021, we were living through another bubble. And I recognized very quickly, I think, maybe because of my history reading or whatever, that this is another bubble that's forming. And it's going to end badly for anyone who's jumping in and investing right now in the wrong companies, especially in venture. But even aside from venture, I think this is going to be a really bad outcome for a lot of people. And I began rereading histories of different bubbles to kind of piece together how I think this is going to unfold professionally. And then I thought, if I'm doing this research, I think a lot of people would find this interesting. And so the book is A Brief History of Financial Bubbles. It's going to cover probably 10 different episodes in history where we had these unsustainable asset price bubbles. It's the ones I just covered, plus Japan in the 1980s, plus a few others. And so each chapter is just a standalone dedicated chapter to here's how the bubble formed, here's why it formed. There are a couple of patterns that are similar between different bubbles. Some of them are different. And here's some of the interesting stories and backstories and characters that really made this thing into a bubble. And then here's how it ended. Some bubbles end with a whimper. Some of them really end with a bang and have long-term consequences. And so being able to parse through the causes and effects is what the what the book is for. I think we'll self-publish the book. It's probably about halfway written right now. I got to find time in my day that I was talking about. I don't have any time in the day to sit down and write, but I find a half hour here, hour there. We'll probably aim to publish it, self-publish it in the middle of next year.
Got it. And sorry, I didn't get it. When are you looking to publish it? Any timeline on that, Aman?
Yeah, probably early to middle of next year. We'll do some pre-marketing for it. We'll release some of the chapters online. We'll do that through our firm, and then we'll publish middle of next year.
Got it. No, looking forward to it. And as you said, you want to do things that you enjoy doing. Is there anything that you've been wanting to do but just haven't got the time yet?
Yeah, it's there is a long list of bucket list items that I want to do. I think when the kids are now 12 and 9, so they're able to, now they can travel with me. They can come with me to different places that I want to go. Yeah. There's a number of travel things that they will be joining me on. I think the things left undone in my life that I'm now reflecting back and thinking, what would I really, now that I'm healthy and still young and can go do things, what are the things I just haven't done that that are top of my list? And it's like seeing the Great Barrier Reef, and scuba diving there is on the top of the list. Just got to find the time to do it. Actually, you're a tennis player, so you'll appreciate this. One real regret that I had was back in 2008. I went to see Wimbledon, and I'm a big tennis fan and I'm a big sports fan, and I'd never seen Wimbledon because it's hard to get tickets, and there are all kinds of reasons why it's hard to go to Wimbledon, right? But I watched it religiously every year with my father and thought one day it'd be great to go to Wimbledon. One day. Finally, in 2021, I was just decided I'm just going to go. Stop making excuses. Just go. I'm not going to live forever. Who knows when I'm going to die? But I know I'm going to get a chance to see some great players, maybe even Djokovic, on center court. So I took my daughter. My daughter had a very different list of things she wants to do. She didn't want to go see a tennis match in London. I was like, you have to come with me. You have to come with me to Wimbledon. It's a once in a lifetime opportunity. She's like, meh, can I bring my iPad? I'm like, sure. You can bring your iPad into center court. Just be quiet. But yes, you can do whatever you want to. She enjoyed it. She was 8 years old. We got to see a couple of great players and Ons Jabeur. We saw Djokovic. So I'm glad I checked that off the list. Tomorrow I'm going to fly down to Los Angeles. I'm going to go to go see Clayton Kershaw on the mound in Dodger Stadium. He's one of my favorite pitchers. He's maybe the best pitcher in baseball. I've never seen him pitch in a home game before. And again, I'm thinking, why? I'm just putting off these things that I know would be fun to do. And so there's a list of things like that every year I try to check off, 1 or 2 of these things on my list. Whether it's travel, whether it's seeing a sports athlete in his prime, experiencing something with my kids. I have a long list I'm working through.
Yeah. No, I think there's a saying where I think it's human nature where we think, okay, once this is done, we'll go do that. But the point is do it whenever you get a chance. I forgot the name of the book. I'll look it up later on and share it with you. The author talks about these things, meaning like living experiences and living them while you're young versus, putting them for later on when you're 60 or above or even later, because you might not be able to enjoy the way you will be enjoying right now. And Aman, thank you so much. I had so much fun having you on the pod. Thanks for doing it. Really appreciate it.
Thank you. Thank you for having me. And my thanks to you.